If you take a look at this chart here on my terminal, it really highlights what John was talking about. It's financial conditions for the U.S. and the Eurozone. The blue line is the Eurozone. The white line is the U.S. The U.S. having much looser financial conditions than the Eurozone, in part because the transmission effect through the euro will be so strong. Andrew, does this mean that the Fed actually has more room to tighten than the ECB when all is said and done?
So we're starting to hear some Fed officials pick up on exactly that point. We had New York Fed President Dudley talking about the fact that the easy financial conditions in the U.S. mean essentially that you're providing more stimulus right now, or conditions are more accommodative, even given current settings of rate levels. So I'd say kind of analogously to what we heard from Draghi, the Fed is also looking at conditions, not so much on the inflation side, but on the financial conditions side, and saying maybe that does give us a little bit more of an avenue and a little bit more of a cushion to raise rates and not have a negative effect on the economy.
Ben, there's always a risk that you take too much away from the market action of the last couple of days, but have we learned in the last couple of days that if the Fed would like to see a steeper yield curve, yes, it's Mario Draghi that's in control?
I think there's something to that. I think a portion of the 10-year bond yield in the U.S. is driven by central banks outside the U.S. and the key player has been Europe recently. I think there are also two other factors at play. One of them, and they also might drive markets in the direction of overreacting. One is that you need to see action to believe it on the part of central banks. So this has been a story of monetary policy gradually moving towards tightening and skeptical markets, pushing back at every step along the way. And that gave rise to the taper tantrum type result in 2013. And ever since then, central banks have been at pains to be very gradual and very, very cautious in terms of their communication. So this is prone to happen. The other factor, I would say, is that the mental model of central bankers is one that's very persistent and one that doesn't always look at current conditions. So the key is the forecast for inflation. Central bankers think about the Phillips curve or the relationship of labor market tightness with future inflation as being the key determinant of inflation over the medium term. So if you're a central banker today, you've had a bit of softness creep in globally, not just the US CPI, but everywhere. And you're looking through that because of your mental model of inflation.